Dear learners, welcome to my channel Educare Horizon. Now we are going to discuss one of the most important topic in financial management, that is capital budgeting decisions. One of the important function of financial manager is long-term investment decisions that is related to fixed assets and procurement of long-term assets. See, as far as a finance manager is concerned, there are four important functions. The first one is financing function. The second one is capital investment or long-term investment decisions. The third one is short-term investment decisions. It is technically called as working capital management decision. The last one is dividend decisions. So today we are going to discuss one of the most important function, one of the most crucial function as far as a financial manager is concerned, that is called as capital budgeting or long-term investment decisions. Capital budgeting pertains to fixed or long-term assets which are in operation and yield a return over a period of time, usually exceeding 1 year. It involves current outlay or series of outlays of cash resources in return for an anticipated flow of future benefits. So we can say capital budgeting is concerned or long-term investment decision is concerned, it requires current investment or current outlay or outflow of cash resources, and we are expecting an anticipated future cash inflows, or we are anticipating a large benefit in the future. Capital budgeting is employed to plan expenditures which involves current outlays but are likely to produce benefits over a period of time longer than 1 year. So we can say capital budgeting is concerned, this is the deployment of financial resources or outflow of current investment which will produce large benefit over a longer period of time. We can say more than 1 year. See, let us see what are the features of capital budgeting decisions. First one is potentially large anticipated benefits. So this is the most important feature. Suppose we are investing right now a huge volume of fund with an anticipated huge benefits in the future. So we can say potentially large anticipated benefits. The second one is a relatively high degree of risk, because capital budgeting is concerned, see, this is the current outflow of fund for an anticipated future inflow of cash. So future is always uncertain. We can't predict what will happen in the next moment. So that is why there will be huge risk involved in capital budgeting decisions. The third important feature is relatively long time period between the initial outlay and anticipated returns. The most important feature of capital budgeting is that, see, there will be a long gap or long period between outflow of cash and inflow of cash. We can say investment, there will be a gap between investment outlay and expected incomes, because in order to execute a project or in order to implement a project, It requires a lot. It requires a lot of time. It requires huge amount. But the cash inflows or incomes may arise only after the completion of the project. It may take more than 1 year. It may be sometimes 3 years, 4 years, or 5 years, like that. Then last feature we can say, they may be difficult or expensive to reverse. See, it is very difficult to reverse. See, as far as capital budgeted decisions are concerned, there will be no question of, or it is very difficult to see reverse back. So we can say there will be no reverse gear as far as capital budgeting decisions are concerned. Even if you suppose we are put the reverse gear, see, the company will lose or the investor will lose a lot of capital resources. So that is why we can say, see, capital budgeting is there will be no question of reverse back, or it is very expensive to reverse, because we will lose whatever investment we made. See, that we will lose. So these are the features of capital budgeting. First one is potentially large anticipated benefits. The second one, a relatively high degree of risk. A third one is a relatively long period between initial investment and anticipated returns. And last one is, there may be very difficult or very expensive to reverse. Then next one, we will discuss what are the capital budgeting process. So before that, we will discuss some capital budgeting is also called as capital expenditure decisions, capital expenditure management, long-term investment decisions, and management of fixed assets. So capital budgeting or long-term investment decisions, also called as capital expenditure decisions, management of long-term investment, management of fixed assets. So next point we will discuss which are the capital budgeting procedure, or we can say what are the steps involved, or what are the capital budgeting process. The first step is identification of a potential investment opportunities. The first step is identification of potential investment opportunities. So the capital budgeting decisions or capital budgeting process that begins with identification of potential investment opportunities. So as far as the finance manager is concerned, or as far as an entrepreneur is concerned, see, it is the responsibility of entrepreneur to find out the potential investment opportunities. So suppose we are providing environmental scanning, see the threats and opportunities. So an investor or an entrepreneur or a finance manager is in the position to identify the potential investment opportunities. And after locating some investments in investment opportunities, the second process is assembling of proposed investments. Then after assembling of proposed investments, the next one is decision making. So we are required to take a decision whether to opt such investment decisions or reject the investment decision. Suppose we are going ahead, the next step is preparation of capital budget and apportionment of fund. And the next step is implementation of the project and performance review. So these are the steps involved in capital budgeting process. First one is identification of a potential investment opportunities. Second one is assembling of proposed investments. Then third one is decision making. Then preparation of capital budget and apportionment of fund. Then implementation, and we can say performance review. So these are the steps. The next point, what are the project classifications? So the projects will be, or capital budgets will be divided into the following categories. The first one is mandatory investments. Mandatory investment means it is compulsory, or it is legally you are required to invest such and such fund, or we can say we are required to implement such and such projects. For example, see, pollution control equipment, firefighting equipment, or crushes in factory premises, etc. So suppose as far as a factory is concerned, see, it is compulsory to install some pollution control equipment. It is by statute, it is compulsory. By law, it is compulsory. Or firefighting equipment. Without firefighting system or firefighting equipment, we are unable to operate any kind of factory premises or any even commercial premises. Or as far as the Factories Act 1948 is concerned, it is compulsory. Suppose we are employing 30 or more than 30 women employees. See, such factories compulsorily, as per the provisions of the Factories Act 1948, compulsorily they are required to maintain a crush to look after the kids of the women employees. Then second one is replacement project. So that means replacement of obsolete and inefficient equipments. Definitely, due to the technological upgradation or innovation, see, maybe our plant or machinery or technology may be outdated or maybe obsolete. So we are required to replace with new technology or new machinery and plant, etc., to improve our efficiency. So the second type of project we can say replacement projects. The third one is expansion projects. See, almost all business organizations, they used to start at very small scale or at a very humble level only, and after attaining a certain level of market, they used to widen their distribution network. They used to expand their production or increase their capacity, etc. So it requires more machinery, it requires more plant, etc. So we can say expansion projects. Or it may be the next one is diversification projects. Diversification means entering into newer areas of products. So it requires more investment in the form of machinery, plant, land, all kinds of fixed assets. The next one is research and development projects, especially for automobile industry or like that of industries. See, they used to update. They used to upgrade their technology, their model, etc. See, by way of incorporating more and more facilities. So we can say research and development projects will be there. And last one is miscellaneous projects like interior decoration, recreational facilities, landscape, gardens, etc. So these are the classifications of projects or capital budgeting investment. So first one is mandatory investment. Mandatory means by statute it is compulsory. The second one is replacement investments or replacement projects. The third one is expansion projects. Fourth one is diversification projects. Then fifth one is research and development projects. And the last one, miscellaneous projects like interior decoration, recreation facilities, landscaped gardens, etc. Then we will discuss the most important point in our capital budgeting decision, that is the methods of capital budgeting, or what are the tools of capital budgeting. So we are already discussed what is capital budgeting, what are the features of capital budgeting, what are the classifications of projects, etc. So now we are going to discuss the most important point in capital budgeting, that is methods or techniques of capital budgeting. The methods of appraising capital expenditure proposals can be classified into two broad categories. The first one is traditional methods, and second one is modern approach or discounted cash flow method, or also called as time adjusted methods. So the methods of capital budgeting or methods of appraising capital expenditure proposals, that will be divided into, or tools of capital budgeting appraisal, that will be broadly divided into two categories. The first one is traditional methods. Second one is modern approach. Modern approach also called as discounted cash flow methods or time adjusted methods. So these are the classifications. You can see this chart. So these are the most popular methods of capital budgeting. First one, traditional approach. The traditional approach consists of two important methods of capital budgeting. First one is payback period, and second one is accounting or average rate of return method. So traditional approach or traditional method, it consists of two important methods of capital budgeting. First one is payback period, and second one is accounting rate of return or average rate of return method. Then modern approach or discounted cash flow method or time adjusted methods consists of three important methods of capital budgeting. First one is net present value method or NPV method. The second one is internal rate of return or IRR. And third one is profitability index, PI method. So these are the three most prominent methods coming under modern techniques or DCF, discounted cash flow methods. First one is net present value method, NPV. The second one is internal rate of return method or IRR. And third one is profitability index, PI method. The main difference between traditional approach and modern approach or DCF method is that in traditional method, we are not considering the time value of money. Whereas modern approach is concerned, we used to consider the time value of money or present value of money into consideration while making capital budgeting decisions. The second difference is that, see, in traditional approach, we will never consider the cash inflows of the entire project life. Whereas modern approach or DCF method, we used to consider the cash inflows for the entire project life while appraising the capital budgeting decisions. The major difference between traditional and modern approach is that in traditional approach, we are not considering the time value of money, whereas in modern or DCF method, we used to consider the time value of money. And traditional methods consist of two important methods. First one is payback period, and second one accounting rate of return or average rate of return. Modern approach or DCF method, discount cash flow method, consists of three important methods. First one, net present value, NPV method. Second one is internal rate of return method. And the third one, profitability index method. See, let us discuss one by one how to calculate payback period, what is payback period, how to calculate payback period, what is accounting rate of return or average rate of return, and how to calculate what is NPV, net present value method, and how to calculate net present value method, and what is internal rate of return and how to calculate internal rate of return, and also see profitability index and how to calculate profitability index.